introduction. My name is Katherine Summerall, real estate with Katherine at Keller Williams Realty, and I've been blessed to serve the Durango community for the past 7 years as your real estate partner. I have served over 130 families, and the reason why I'm coming to you today in this platform called the Conversation Series is because I felt a need to step up not only as your real estate partner, but also your community partner, and thus bringing to you information that can help provide sound perspectives and help us all navigate through some interesting times that we have going on. And so with that, I have the pleasure of introducing Pat Barrett. Pat is with Tafoya and Barrett Associates here in Durango, and they are a local CPA firm whose mission is to make a real difference and positive impact in the lives of their clients, but doing so by providing high quality financial services that certainly exceed client expectations and while actively contributing to our community. So we're very blessed to have such a wonderful firm supporting us, both taxpayers and small businesses. So Pat, thank you for your time. I know that your world is very, very busy and changing probably by what feels like the minute. So we'll make sure to be respectful of your time, and would love for you just to jump in and kind of share with us what we're going to be talking about today.
Okay, great. And thank you, Katherine, for giving me this opportunity to share kind of some of the information that we've been trying to get our heads around as kind of some of this legislation has come down so quickly, as well as, you know, the guidance that we keep searching for. And the guidance seems to change, like you said, almost, you know, daily. I think last week it felt like it was hourly, out of the fire hose, you know, like a lot of folks. And, you know, a lot of these platforms and some of your discussions have been talking a lot about the PPP loans, Paycheck Protection Plan loans, and rightfully so. Those have gotten, you know, a lot of attention. And today I'm going to try to broaden the conversation. I'm going to touch a little bit on the PPP loans, but then I'm going to move into a broader discussion about some of the other tax provisions that came out of the CARES Act and some of the things that we're trying to deal with. Kind of the first thing that I wanted to talk about is basically the main reason why I'm able to sit here and have this conversation with you on April 14th of all. And that goes to the postponement of the filing deadline. Everyone is very familiar with the April 15th filing deadline, and also happens to be a payment deadline as well. The IRS has been kind of coming out with a couple of different announcements that keep building on each other, and they've postponed kind of quite a few filing and payment requirements that are due between April 15th and July 15th. And it's pretty much gotten to the point that, particularly with income tax filing and payments, pretty much anything that falls within the April 15th to July 15th timeframe has been now pushed out to July 15th. So from our perspective as practitioners, we've gotten a little bit of relief there. And obviously businesses and taxpayers have gotten relief on, you know, when they have to make that financial outlay, if they still have some tax payments that are due for 2019. And it also extends the due date for making quarterly estimated tax payments for 2020. And that includes the first quarter payments, which are usually due April 15th, as well as the second quarterly payments that are due June 15th. The first iteration did not include those June 15th estimates, so we kind of had a weird situation for maybe a week or so where the first quarter payments were due after the second quarters, but that got cleared up. Also includes state and gift tax returns. But I would caution people that if you are dealing with some income tax situations that are beyond income tax, and mainly payroll taxes, and I believe most excise tax returns, if they were originally due within that window, as far as we know, those are, you know, still due. So you do still have to pay attention to some of those other deadlines. And with regards to the PPP loans that I spoke to a minute ago, late last week, we kind of started to shift gears a little bit on our end on helping our clients and advising them. We were involved with helping, you know, quite a few people on the application process, but we started seeing some of our clients actually getting approved, which was a good thing, and getting some funding. So we wanted to try to get out ahead of our clients with regards to what we think is, coming next, maybe 8 weeks out or so, definitely sometime between now and probably the June 30th timeframe, is applying for forgiveness. And we want to make sure that people kind of have their ducks lined up in a row on the front end, so that process hopefully goes as smoothly as possible. And there are some very stiff penalties, and can go as far as fraud, that the SBA has in place, that if any of the funds that are granted through a PPP loan, and even the EIDL loans as well, potentially could be subject to fraud. So the penalties could be pretty stiff. So we're encouraging our clients to kind of follow some best practices, and we've posted them out on our website, which is tafoyabarrett.com//COVID-19 updates. We have a good list of some information I think people should be taking into consideration in preparation for applying for forgiveness. And I'll just try to run through them real quick, because we don't have much time here today, and there's definitely some other topics I want to cover. But we're advising our clients to open a separate bank account to hold these funds. Even though that's not required, we think it creates a good infrastructure to leave an audit trail, so that you could easily track where the funds went and demonstrate to the SBA that they were used appropriately. You also want to keep track of all of your payroll tax reports that you file within this 8-week period that begins from the date you receive the funds. You have 8 weeks to appropriately spend the money. You also want to keep copies of your payroll reports that you get from your payroll processor, and keep that information handy. You should probably set up a folder now to start putting these documents in there. And that would also include documents for payments for health insurance, payments for funding retirement plans, the employer's contribution. You also want to make sure that you have handy a copy of any of your leases. If you're going to use some of these funds to pay your rent, your lease has to have been in place by February 15th of 2020. Your lease maybe is 5, 10, 7 years old. Maybe it's tucked away in a file somewhere. It's probably a good idea to go track that down and have it handy. You also want to make sure that you keep track of statements for payments of any mortgage interest that you're going to include in the forgiveness as well, and also copies of canceled checks and invoices and statements for payment of utilities that you want to qualify for forgiveness as well. So that's kind of a quick rundown of some of the best practices that we're trying to get our clients to implement to, again, stay out ahead of this. So,
well, and I love that, because though that may seem painful or an added to do for right now, I love that you're really having that foresight, or encouraging people to have that foresight, that do the work now, so that we can ensure that that we're doing what we can control to streamline that forgiveness process. So yeah, I think that's really key, and it's really tactical things to do in the moment right now, today, to help prepare for you in your business in the next 90 days, 180 days. So I really appreciate that. One question, and I'm going to kind of go back to the overview of the PPP loan and the EIDL loan. Curious, and we didn't necessarily talk about this, I think it may be a good question for the conversation, is can you use those funds in relation to your potential tax liability or payments that have been deferred, to July 15th? Is it an opportunity for businesses that maybe are low on liquidity to use those funds? Do you know that?
well, I think it's clear on the PPP loans. I do not believe that would be an appropriate use of those funds.
Okay.
They're pretty specific. The EIDL loans, their permitted uses are a little bit broader than the PPP loans.
Mm-hmm.
And, I don't know that I specifically have an answer to that question.
Totally okay, right?
Yeah,
because sometimes we don't have the answer, but it's just good to talk about it.
Right, and probably the place to look would be to double check with the SBA.
Okay.
Those EIDL loans come directly from the SBA. There's not a bank or another third-party lender involved. So
Great.
I would be careful about doing that.
Yeah. Yep. No, yeah, thank you for providing some perspective to that.
Sure, sure.
So yeah, best practices, certainly start staying organized, be tactical, like everything, being documented now will help you, certainly help make, the service providers that you're working with be able to serve you better or serve you more efficiently. So I love that perspective. So thanks for that.
Sure. Yeah. And hope that application process goes as smoothly as possible.
Yeah.
And then kind of still just touching on the PPP loans and the EIDL loans, there are some income tax implications or non-implications, depending on how you look at it. Specifically with the PPP loans, the forgiveness is clearly non-taxable income. And so that's definitely a very unique feature with those loans. Usually, just generally speaking, forgiveness of any debt is usually treated as taxable income, but with the PPP loans, it's specifically excluded. The one discussion that's going on within our profession, and I sat in on some continuing education last week and heard from a couple of different, what I would call sort of gurus in our profession, there's this open discussion regarding whether or not the IRS is going to allow you to, and or whether or not you will be permitted to still take tax deductions for the payment of expenditures for which you use the PPP loan funds for. It's still that answer because it's a net zero. It doesn't hurt you, but that's kind of, I guess, an aside issue that's out there that people are talking about. And again, we're looking for guidance on a lot of this stuff. So stay tuned. That's just something that's out there. The other issue that we're trying to get some guidance on, and we have not been able to find any clear guidance on, is whether or not the grant that's tied to the EIDL loans, it's a grant of up to $10,000 that, again, it's more or less a loan that's forgiven, thus that's what makes it a grant, as to whether or not that is going to be taxable. We don't have, like I said, clear guidance on that. Generally speaking, the way the Internal Revenue Code works is that any receipt of money is taxable income unless there's an exception. And we have yet to find an exception for the EIDL loan grant. There's clearly one out there for the PPP loan forgiveness, but again, that's just something out there that we're looking for guidance on. Then I kind of wanted to move away from, those loans and jump into some of the other tax provisions, as I mentioned. And the first two kind of have to deal with some payroll tax relief. There's an employee retention credit that was included in the CARES Act. And that credit is a payroll tax credit that you would claim on your payroll tax return, not your income tax return. And it's essentially equal to 50% of wages paid to eligible employees up to $10,000. So it's a 50% credit on the first $10,000 of wages per employee. So depending on the number of employees you have, that could add up. And eligible employers essentially are employers whose operations have been fully or partially suspended as a result of a government order limiting commerce, travel, or group meetings. So I think with all of the stay-home orders,
right,
that's going to pretty much apply pretty broadly to most, if not all, businesses. And you get to include in that wage number also any health benefits that are out there. And the one thing I want to point out with regards to that credit is that you cannot receive that credit if you received loan funds from a PPP loan. And the one thing we don't know is, does that just mean my payroll within that 8-week window that relates to the PPP loan forgiveness, or am I just totally disqualified from receiving this credit if I got a PPP loan, regardless of the amount and or the length of time? Another payroll provision that's out there, there's a delay in the timing of when employers have to pay the employer's share of Social Security tax. And that's essentially for any employer's share of Social Security tax incurred from the date of enactment through December 31st of 2020. You can defer the payment of those payroll taxes. 50% of them are due by December 31st of 2021. The other 50% is due by December 31st of 2022. So quite a time delay on having to pay those payroll taxes. However, once again, that same provision is out there where there's no double dipping. If you did qualify for and receive funding through a PPP loan, the statute indicates that you're not eligible for that deferral. And again, we're waiting for guidance as to whether it's just related to the wages that I'm using the PPP loans funds for, or am I just totally shut out of that benefit? There's two other business provisions that were included in the CARES Act that have the potential to generate some cash and tax savings fairly quickly for certain taxpayers. And the first of those two provisions is a modification that was made to what are referred to as the net operating loss carryback rules, or NOL for short. You used to be able to carry back any net operating losses, which essentially is a business loss that is not used to offset other income of a taxpayer in a particular year. If they wind up with a net loss for a year, used to be able to carry it back 2 years and forward 20 years. And the Tax Reform Act of 2017 came into play in 2018, did away with that 2-year carryback provision. The CARES Act, it reinstituted a carryback provision. You can carry back losses that you had not only in 2020, but also 2018, 2019, and 2020. You can carry them back for up to 5 years. So if you happen to be a taxpayer who had a rough time in 2018, you can go ahead and by June 30th, apply for a quick refund and carry back that loss back to any of the 5 previous years prior to 2018. If you had a loss in 2019, already filed your tax return, right now, tomorrow, whenever, you could do the same thing, file for a quick refund, carry that loss back up to 5 years and get some of your, previous year's tax dollars back quickly. The IRS is supposed to act on those quick claim refunds within 90 days. So,
Wow.
something there.
That's a great insight for a select for a select population of business owners.
Right.
If that can apply to you, I love what you said. That's something that can increase potential cash flow here relatively soon.
Right. And it's, some bright light on the horizon, if you will, for all those suffering in 2020 to know, if you had a good year in 2019, 2018, obviously you have to wait till almost a year from now, a long time out, but you'll be able to take advantage of those 2020 losses and get some refunds back pretty quickly.
That's great.
The other one is kind of a little nuance that's out there. Again, it's kind of tied in to the Tax Reform Act from 2017. There was a drafting error in the language, and this might apply to some of your real estate clients, those that are in commercial real estate. And basically, the drafting error that came out of the Tax Reform Act created a useful life for depreciation for what is referred to as qualified improvement property, which is really leasehold improvement costs that may have been paid for by either the tenant or the landlord. If you incurred those costs in 2018, you were required to use a 39-year depreciable life, which basically means you had to write off those costs over a 39-year period, which is pretty lengthy. Mm-hmm. Intent was for that period to be 15 years versus 39. And the CARES Act came along and made what's referred to as a technical correction to correct that drafting error. And the significance of a 15-year useful life is such that if you have a useful life, I know I'm getting into the weeds here, but if you have a useful life for depreciation purposes of less than 20 years, you could take advantage of what's referred to as bonus depreciation and write off 100% of those costs in the year in which you incur them. So now that we have this correction in place, if in 2018 you were depreciating your qualified improvement property over 39 years, just got a small deduction in 2018, we're expecting a small deduction in 2019. And again, if you haven't filed 2019 yet, you can go ahead and make this correction and adjustment on your 2019 tax return. File it now, reduce your 2019 taxable income by that 100% depreciation that you were entitled to in 2018, which will maybe, if you were overpaid on your 2019 estimated tax payments, you can get some of that money back, sooner rather than later. If you happen to already file your 2019 return and 2018 return using that 39-year life, you have to go back and amend the tax return. A little bit more involved process, but you still have the opportunity to go get, some of those previous tax dollars back quickly.
And I appreciate you going into the weeds on these things, like what you said, because this is you are extremely knowledgeable in this. And I think that the value that you're giving to those that speaking to this specifically, and we will address other things as well, is really key, right? Because that's why we have professionals of which we lean into. So thank you for sharing that with us and helping to provide some insight that, hey, if this speaks to you, there's opportunity that you may want to engage with further.
Yeah, and if nothing else, just go talk to your tax advisor, whether it's us or somebody else, and say, hey, is there something here I could take advantage of, and help me with this economic impact crush that I'm feeling, with this whole COVID-19 issue that we're all dealing with. Had just a couple other points. I'm going to bounce around a little bit. Some other provisions that are out there are some relief with some IRA distributions, especially for those individuals who are under age 59 and a half. Generally speaking, there's a 10% penalty if you withdraw money from a retirement plan before reaching age 59 and a half. That 10% penalty is waived for certain taxpayers. The taxpayer either has to be diagnosed with the coronavirus, or their spouse or dependent diagnosed, or, again, this is kind of a broad description, experienced adverse financial consequences. And again, I think there's a lot of people that are going to fall into that bucket, even if they were fortunate enough not to be diagnosed with the virus.
Quick side note, I just want to, because I think that's good insight that I don't think is maybe as public knowledge as some of these other hot topics. We are bringing on a financial advisor to come speak to just practice conversation around finances. So that's happening this Friday at 1:30 as well. So I think that, just wanted to segment in that real quick because we were talking about finances, and I think that that's going to help some people, or I think some people need to know that.
Right. And again, I think the financial advisor will probably agree. We think tapping into your retirement account should be a last resort.
Sure. Yep.
But it is out there.
Yep.
Another good feature with that provision is if you pay it back within 3 years, not only are you not subject to the 10% penalty, but you don't have to pay any income tax on it.
Oh.
Another nice feature is that if you're unable to pay it back within that 3-year period, you basically don't have to pay the income tax on that distribution for 3 years.
Okay.
So, there's kind of a couple different nuances in there that provide some relief for some folks. Then this is affecting maybe some people that happen to be fortunate enough to be in a pretty good financial situation, but some elderly individuals, depending on your age, either beyond age 70 and a half or age 72, there's a provision out there that you have to start to draw down your IRA or your retirement accounts. It's referred to as required minimum distributions. Okay. Requirement to make the required minimum distributions has been suspended for all of 2020. And, that's essentially in place for people not to be forced to have to liquidate assets to make these required distributions out of their retirement accounts when the financial markets have taken such a big hit. So they're giving the financial markets time to recover before people have to, start to liquidate to meet the required minimum distributions.
And as you're, for those that are watching and those that are going to be watching on the recording, as you're listening to this information, take note if your family members or community members that you know of. I mean, where we can help support one another is by sharing this type of information and this type of resource. So I appreciate you bringing, even just those points up, because things that I would guess, a good portion of people don't realize.
Sure. And then there's a couple other nice provisions out there, but again, you're not going to see the impact from them till about a year from now because they're tied into the filing of your 2020 tax return. But they created a new deduction for charitable contributions, even for people who don't itemize their deductions. It's, not very significant, but it's $300 charitable deduction. And again, they're trying, I think, to encourage people to help those that are in need now. And then also there's a limit on the amount of charitable contributions you can deduct in any tax year. It's usually tied to your total adjusted gross income. Lately, it's been running at 60% of your income. You could not get a current benefit if you made charitable contributions above that amount. They've kind of removed that 60% cap, and now you can go up to 100% of your income. So again, that's kind of a nice tax benefit that's out there for people who happen to be in a good financial position but want to help out, the needy currently. So
Yeah.
again, some incentive there to help out. The only other thing, I know we're kind of running out of time, was, whether we're being referred to as the individual economic impact payments. I think everybody has seen a lot about this in the press. A lot of people are anxiously waiting for their payment. $1,200 for a single individual, $2,400 for a married couple filing joint. Then you get to add on $500 for each dependent child under the age of 17. There are some income limits on who qualifies for those payments. And for a single individual, it starts to phase out when your income hits 75,000, and it completely phases out or comes to zero, if you will, once your income hits 99,000. So if you're in that window, you probably, you won't get the full $1,200, but you might get something. A lot of people that were asking, well, what if I don't file tax returns? Everything I read says they're basing it on 2018 or 2019 income tax returns. I haven't filed for a couple of years because I don't have to, but I'm still entitled to my $1,200. The IRS has created a portal that non-filers can go to, and this portal got turned on or came live, if you will, last Friday, and non-filers can go ahead and enter into this portal that the IRS has on their website. And I think, Catherine, maybe you were going to kind of share that.
Yep, I'll get all the links out to everybody and post them.
Yeah. And so they could put in basic information, name, address, social security number, number of dependents, how they would file, married filing joint or single if they were to file. And then interestingly enough, you put that information into the IRS's website. You could put in your bank account information to get your direct deposit. And then the IRS transfers that to a third-party vendor, but it's a free service. And that third-party vendor basically prepares what's referred to as a simple tax return that has just that basic information on it. And then they submit that to the IRS. So then it's in the IRS system and you can get your refund quickly. There's another feature to that portal that has not been turned on yet. And that feature is going to be for people who have filed their tax returns. They can go in and check on the status of their payment. And they can, because they're going to roll these out, I think,
Sure.
Income levels. But that portal is, I believe you can also go in there, and if the IRS doesn't have your bank account information on file, I believe you'll be able to enter your bank account information so you can get your check directly deposited rather than waiting for the check in the mail. Those folks who the IRS doesn't have the bank account information on that are going to be receiving checks, they probably won't be seeing those checks until midsummer or so is what we're hearing now.
So what I'm hearing, one of my questions was, what actionable is needed, to receive these checks in the mail from the Fed? What action is needed from us? It sounds like to go and make sure that we have you, we can check our status through that portal potentially and put in our bank account information. Is there any other actions? And then you spoke to non-filers, if you have not filed, then this is your action. For those that have filed, is there any other actionables that they should take in order to control to their best ability, their ability to receive that money?
Yeah, I think the best thing you can do is to go look at your 18 or 19 individual income tax return and see if you were in fact entitled to a refund and you had that refund directly deposited into your bank account. If that happens to be your situation, you do not need to do anything. The money will show up in your bank account. If you go and look at your 18 and 19 tax return, you filed a tax return and you believe you're entitled to one of these checks because your income is in, the right bracket. I'm not sure if I mentioned for married, bounced around a little bit, for married filing joint, it starts to phase out at 150,000 to 198,000 of income. Okay. But back to your question, if you did not give the IRS your bank account information in 18 or 19 for direct deposit, probably the best thing you could do is go to this portal that's out on the IRS's website. They say it's going to be active mid-April, and tomorrow's April 15th. I checked it a half hour before I got on this conversation and it wasn't live yet, but that's where you can go in, enter your personal information, and I believe you're going to be able to enter your bank information to get direct deposit. And if nothing else, be able to at least check on the status of your check or payment that's coming your way.
Awesome. Well, I told you I'd respect your time because I know you're very busy. Do you have any other kind of just, details? As I think we've covered a whole heck of a lot. And I'm sure glad, I've told this to you so many times, but I am sure glad that you guys do what you do and are advising us because it's a lot, it's fluid, it's changing all the time. It's very complex. So I appreciate you doing your best to just simplify and share with us what we need to know.
Sure. I guess the only other thing out there that I meant to touch on, I kind of blew right by it, is circling back a little bit on the PPP loans. We're still looking for and hoping for very soon, if not like today or tomorrow, to get some more guidance on self-employed individuals. Mm-hmm. It seems pretty clear as to what's needed to be done and what's needed to be included on the application for a business owner who pays wages, but there's been little to no guidance regarding self-employed individuals. We understand that the SBA and the Treasury might be in the process of drafting that guidance, and we'll hopefully be issuing it, again, like I said, within the next day or two. So if you happen to be self-employed and you're curious about that, I think you just want to kind of stay tuned.
Sounds good. Well, and and as the whole intent of this series is to provide the crucial information or the perspectives that we need. So as I know that as that is received, I know you'll be distributing that out, and I'll do my part in helping distribute information as well. So if we do have any questions from those that are listening on, I feel free to type those in, whether that's on Zoom or on Facebook. If we don't get to those, I'll make sure that the questions do get answered. And Pat, if there's a way to reach you or your team, or if people have questions, how should they go about doing that?
Well, you can always pick up the phone. I'm a little old school sometimes. Call us at Tafoya Barrett & Associates, 970-259-8000. And we are active out on the internet, www.tafoyabarrett.com. And as I mentioned earlier, we do have a COVID-19 resource page that has some resources out there. And again, has some more details on these best practices in applying for forgiveness. And yeah, we'd be happy to hear from anybody. And again, our goal is to help people navigate their way, through all this legislation that came down so quick, and
right.
And the guidance that is coming out rapidly, daily.
Yeah. Well, Thank you. Very grateful for you. Thanks for coming on. I know a lot of people, when we say taxes, they go like this. They're like, I don't want to know. And man, you are just, have shown that you guys just know what you're doing, are able to advise. And so I just encourage everyone that's listening to this, engage with your professionals. We've talked about this over and over, whether that's your banker, your tax professional, your real estate agent, your financial advisor, whoever your team is, engage with them to help support you. And of course, if you need recommendations, reach out to me. Happy to help connect you with those parties. Reach out to Pat, and we're here to serve you. So we're a little past 2 o'clock, so I'm going to go ahead and sign off. And Pat, you're awesome. Appreciate it.
Okay, great. Thank you, Catherine, and thank you for pulling the community together to have these conversations. Really appreciate it.
Wonderful. Appreciate your support. Talk to you later.
Okay.
Bye-bye.